covering this investment strategy, putting a plan in place, financing your properties. On the longer term will provide higher yields than you will in the city because they carry from an investment point of view. You're probably not going to get the same growth as you would if you bought something older.
Welcome and thanks for joining us for episode 7 of the Momentum Wealth podcast series. My name's Aaron DiCamillo, manager of the Property Wealth Consultants. With me is our founder and managing director, Damien Collins. Damien, great to have you with us again.
Good to be here again, Aaron.
Good. Now, this is a 10 podcast series, all about the fundamentals of property investment. And we say this every week, but it's so much more than just finding the right investment property, isn't it?
Yeah, absolutely. So, I mean, finding that investment property is that really critical thing. But as we've been saying each week, it's getting the right strategy for you. Every person's different, so you can't really choose the property until you know what your strategy and plan is, and based on your circumstances and your risk tolerance and many other things. It's also about getting the finance structuring right, buying that property, but also getting it well managed and looking to value add to properties, whether that be renovation or development, to speed up that wealth creation process.
Sure, and going on to today's topic, one of the sexier parts of property investment is all about developments. So we're going to be talking about finding a development site, managing a development project, funding the development, and then also whether a development syndicate's right for you. As usual, we'll have our bonus at the end of this podcast, so stay tuned and we'll fill you in on the details at the end of the series, end of the podcast. For now, why be a property developer?
Well, that's a good question, Aaron. And look, probably everybody shouldn't be a developer. There's certainly some great upsides to it. You can certainly speed up your wealth creation process, and for most investors on their own, probably the development component of it would be develop to hold. So maybe create that additional equity, so it really starts to speed up that wealth creation process. So that's a good reason. Also, you could potentially develop to sell as well. Some people might like to do that, but that's in the riskier end of the spectrum. You can make a lot of money, but it's not for your traditional investor. They really need to leave that up to professionals.
Yep. So there's 3 main ways that we're going to look at today about developing property. The first one is to do it all yourself. Yep. Secondly, we can look at appointing a project manager, essentially. Yep. And the third way is to jump into a syndicate where you're pooling your funds with other investors to produce a development site. Yep. Starting with doing it yourself, we'll look at the pros and cons. What are some of the positives and negatives of doing it all yourself?
Well, I guess if you do it all yourself, you don't have to pay someone else to do it. So that's probably the biggest positive. But it does take a lot of time, a lot of skill, a lot of knowledge, a lot of coordination. I mean, when you go through a development project, and particularly if you haven't even got the site, I mean, doing all that financial analysis, feasibility, the planning, research, there's a heck of a lot to it. And if you get something wrong, which I've seen novice developers do, then you can quite easily lose a lot of money. So we've certainly, I've seen over the years that people, we do feasibilities all the time in our office, and I've seen people pay prices for sites that we know they'll be in a loss-making position, particularly on the smaller end of the scale. A lot of people get sold, this is great, I'm going to be a developer, but don't do all the homework and research that you need to do before getting into it. So I think for most people, doing it yourself, certainly as a development, can be a risky game. It's a pretty risky proposition. So
certainly the risk and the time involved make it very difficult.
Yeah.
So if you go down the path of appointing a project manager, what are some of the things we need to look out for there?
So a project or development manager, most likely would get in from the very beginning, before you've even got the site. And so what they would do in a normal scenario, you would expect, is walk you through from feasibility. They would do the planning reports, checking that it's working with external consultants if necessary, to make sure it's a viable site and you're actually going to make money on it, be able to do what you want to do. And they'll basically guide you through the whole process and take you through all the consultants that you need to deal with, appoint the builders, manage the builders. So they call it project management. People think, it's managing the on-site part of it, but that's only as part of what you do as a development manager. You actually end up managing it from the very beginning right through to the end of the project, appointing sales agents if there's sales, and handing it over at the end to if it's a rental as well. So we have clients that do that. They appoint a development manager, they're independently got a bit of net worth, and they just go about their business or their job, and they appoint some professional team to look after that whole journey for them.
So looking at a single development for a single investor can be a big proposition. Yeah. The third way of getting into a development project is through a syndicate.
Yeah. And look, it's also, that's risk mitigation as well. Sure. So for example, let's say you could afford to do a $10 million development on your own, you'd need about $3 to $3.5 million of capital at least up front, so that's a lot. But it's also a lot of eggs in one basket. You're certainly putting all your eggs in that, and if that project comes off, well, that's fantastic. But if it doesn't come off, all your assets are tied up in that particular project. So what we see more and more is that people start to pull their money into syndicates. Generally, they're run as unit trusts or companies sometimes, but mainly unit trusts. And so you might put in 100 or 200 or 500,000 amongst another 20 or 30 or 40 investors, and you pull your money together. It enables you to get access to better quality sites. You would generally have professional development management in there as well, and means you're spreading that risk around. You might be able to go into 4 or 5 developments rather than just putting all your eggs in one basket.
Sure thing, okay. Let's take a step back for a second. If we're going to start our own project DIY, or we're going to appoint a development manager, funding the project is very different to a normal residential investment. So what are some of the things we need to look out for from a financing perspective?
So it is very different. And I guess there's traditional residential investment. You can borrow 90% or thereabouts, or 95%, and you only need a smaller deposit. They base the income on the servicing of whether or not you can afford that loan based on the expected rental income. And so when we start getting to development, that's where the rules start to change. So I'll look at a small-scale development first. So let's say you were doing maybe up to 3 units. Some of the banks think maybe do still 4, but 4 units. But at 3 units, you can generally fund that as a normal construction loan. So you can still borrow 80%. You might be able to get into mortgage insurance territory, depending on what the mortgage insurer's policies are at that time, but it's harder. But you can generally borrow 80%. They'll assess the expected rental income that you would get, and you're developing those generally on the basis you're going to hold them as rental properties. But once you get out of that space, out of the traditional residential area, and you go into anything generally 4 and above, that's when you get into the commercial space, and they've got a whole different way they look at it. They're not looking at it, you're holding it for 30 years. They're looking at it on the basis, right, what's the exit strategy? How are we going to get our money back? This is a 2-year project or 3 or whatever that time frame is. And so the equity required is a lot more. They see development as riskier, which it is, and so generally you'll need 30 to 35% as money that you're going to have to put into the deal, so it's quite a lot of capital. Yep. And look, these things all do fluctuate depending on the state of the market and what the banks are like and what the lending environment's like. But and they also will generally want pre-sales of the project, particularly the more units you have, particularly so, the more they want the pre-sales. And that they're looking at, well, that's the exit strategy, right? So for that development, if they're building 20 units, well, we're worried about getting our money back, so we want to see pre-sales. And again, that can range depending on the market cycle. It can be range from, I've seen it as low as 50% in really strong cycles where the banks are trying to get a lot of money out there in the market and lending it out. And I've seen it also the other end of the scale where they want 120% of the debt pre-sold, and so that does stall a lot of projects as well. And it makes it hard too, on the small projects particularly, to get pre-sales, because you've got to spend a lot of marketing money and energy, unless you're really in a boom market. If it's in a normal market, or particularly even in a softer market also, you've got to get it's harder on the smaller projects to do that.
And I guess the other thing to consider that for the lenders and the banks, it's short-term lending and it's high risk for them, so they're not going to be that eager to throw the money over to investors. No,
they certainly see it as part of their lending book. Absolutely, they'll charge you more interest for it. So, but they certainly want to get their money back. So, end of the day, that's what a bank thinks like. They don't think about, oh, this is a great project. That's part of, I guess, their assessment. They look at risk. How can we minimise our risk? And they want their money back. Yeah.
So, assuming we're now past, we've got our finance in place for a project. We're now working at our strategy, and we're looking at whether we build the development to hold them or we build to sell.
Yep.
When would we look at those options?
Well, that would be part of your initial strategy as an investor first. So You'd be saying, firstly, well, what's my plan here, and am I going to be holding those or selling them? So obviously, working back from that, if you're developing to hold, certainly the amount of research you need to do goes up another level, because it's not just about the planning and the feasibility of that particular project and if it's profitable now. It's also, okay, well, what's this area going to be like in 10, 15 years? Because I'm not just getting in here to sell and leave. I'm getting in there to hold for the long term. So you've got to be thinking like a developer, but also like an investor as well. So you've got to put your investor hat on and be making sure that it's designed for the market, that it's going to be rentable and be there for the long term. The other thing I think is Certainly if you're selling, you can go into some different areas. Maybe it doesn't matter as much that it's going to be great in 20 years. It matters what is it going to be like in the next 2 years, and is there demand for that particular product. But developing to sell is riskier because you're at the mercy of the market cycle more. If your plan is you've got to sell to get out, whereas if you're developing to hold, a little bit less riskier because you're worried about the rental market at the time and not so much about what you're going to sell it for.
So just touching on that point of the researching of the development site before you kick off, basically, you're looking for sites. You've got a couple of different options. You can go and look yourself, a do-it-yourself option. You can go and talk with sales agents and see what they've got available, or you can go through a buyer's agent.
Yeah, and look, again, doing all the research yourself it's going to take a lot of time and energy. Understanding a local planning scheme and local council policies, that can be a lot of work in of itself. And so you could hire, I guess, a town planning consultant. That'll cost you a lot of money, especially if each deal, you don't know whether a deal's going to come off or not. Certainly, you can talk to the sales agent, and when I'm developing and when our team are acquiring sites for our clients and our syndicates, we certainly do talk to the sales agents, but end of the day, they're working for the seller selling a product.
Sure.
They want us to buy it. So we get some information from them, but just we're conscious that they tend to be very bullish. So we say, well, what sort of, if we're building a 2-bedroom apartment, what would we get for it in this area? And they tend to be a bit on the bullish side.
Yep.
So we go and do our own research as well, and because at the end of the day, it's our neck on the line and clients' neck on the line. So we want to make sure that what the market is, the real sort of value in the market. So look, sales agents are definitely helpful in that process. Obviously, a buyer's agent is working for you, so you're paying someone to go and find you that property, and they're working for you, so they're legally obligated to work in your best interest and get you. And look, a good buyer's agent obviously knows that as they are working for you, sales agent, well, they've sold the property, that's their role. Buyer's agent, obviously, they want to make sure they get you a site that's feasible, because that's what you're paying them to do.
And I guess we see that a fair bit. We'll have clients come to us with a they already own a development site, and we have to try and make feasibilities work. Sometimes they don't quite stack up, as opposed to starting fresh, or we can actually take into account the client's criteria before we go and find a site for them. Yeah,
exactly. So we can, basically works down to what they can afford, what their long-term goal is, and their strategy. And for development can certainly fit into client strategies, but it's got to be the right time for them in the right stage of their investment journey.
Sure. One thing we do see is that investors will come to us for the development site they've bought in an area that they know, might be their local area. Not always a great idea for them, though, is it?
No, and Aaron, often they haven't done feasibilities. And I guess the other problem is they actually don't know how to do them, because there's so many different things that go into a feasibility and a financial feasibility analysis of a project. There's, certainly at the top you've got to take into account market. It's all very well to say, you can build 20 apartments here, but if there's no demand for apartments, that makes it a moot point. So there's a lot to do, and I find a lot of people do-it-yourselfers don't do all the proper research and feasibility analysis and not understand all the costs that go into it. Some of the councils have developer contributions. People go, I didn't know that, and they've hit for $400,000 that they didn't even take into account.
Blows it out of the water.
Blows it, absolutely.
Yeah. Just on that point, some